Welcome to Talking New York Real Estate with Vince Rocco. Our show is all about the exciting world of real estate and in particular, how it relates to the luxury New York marketplace. But if you are not planning a real estate transaction in New York, we still have plenty of information you can use no matter where you are. Now, here's our show. Good morning, everyone. Today on the show, what is next in New York City real estate? So Molly Townsend recently wrote in one of her weekly articles saying that Fred Peters wrote a piece for Forbes last year describing what he called a tornado market, a market where conditions shift wildly without warning, where a property can sit for months or sell overnight, and no one can predict which way the winds will blow. Nearly a year later, the tornado hasn't gone away. If anything, it's picked up speed. The market is still chaotic, but showing signs of a sustainable pace. So the difference is that now some agents have learned how to move inside the tornado and others are still standing still, waiting for calm skies that may never come. In a tornado, standing still is often more dangerous than moving. The same is true now. You can't predict every shift. You can't control the wind, but you can control how you move inside of it. So there are two kinds of agents right now, those who wait for the weather to clear and those who know how to make it rain. Which one are you? And by the way, our buyers and sellers are also affected by these tornadoes. We're going to get into all of it today. And at the table with me today are Roberto Cabrera from Brown Harris Stevens, Jared Anton from Elegran Forbes Global Properties, and Matt Mellinger from Brown Harris Stevens as well. And they join me now to discuss. But first, let me welcome my listeners and my viewers from across the United States and all around the globe. I am Vince Rocco, and this is Talking New York Real Estate. So let's go behind the headlines and inside real estate, the state of our industry.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
So we're going to talk today about, probably contrasting opinions on what our marketplace is right now, where we're going next. Some people say it's a tornado, which is a windstorm, which is up and down and really you can't predict anything. Others say we're kind of stabilizing, we're sustaining, and things seem to be moving, in more of a regular pace than not. Not to say that transactions are up, but we've kind of calmed down a bit. And hopefully, the end goal is that business starts to pick up even more than I think it started a little bit so far this year. But we're going to get into all of it. But Jared, I want to start with you because, and by the way, we got the A team here today, so I'm very excited about that. You were recently quoted in an article for Forbes, and it says, and in my intro, I referred to our markets as a tornado. In the article that you were quoted in, the author said, decade after decade, New York City remains steadfast in the face of adversity. Boom gives way to bust, slump gives way to revival, and the market resets and thrives while the skyline remains unmoved. Resilience is Manhattan's defining trait. You say, after years of feast and famine, Manhattan real estate is no longer lurching between extremes. It is now operating at a measured and more sustainable pace. Can you explain that for us? Because again, this contrasting thought or opinion, go.
Sure, happy to, and thanks, Vince, for having me back. Always a pleasure. The big headline that I would label the Manhattan market right now is stable. The market is fundamentally stable, and that's really important because we've had the boom years of COVID and the low interest rates where contract activities were off the charts high, and then we had the post interest rate increase where we were in a contract volume slump. We are fundamentally coming back to a period where the market is fundamentally normal. Contract volumes are coming in at average. April's contract volume came in at the seasonal average. Although it was down a little bit from March, that's actually normal. It is quite normal in our market to see a slight decrease in April versus March before picking up again in May and June. Year over year, contract volumes were up about 14%, and this did mark the first time in almost a year that, again, Manhattan's contract volumes were at the seasonal average. So what's important is that there's a fundamentally balanced market. We're in equilibrium. Supply is not running away. Prices are starting to firm up and move to the upside. So we are in a functionally healthy and balanced market, and that really is the headline in and of itself.
Yeah, it's interesting to me. By the way, I like the word equilibrium because I think, when equilibrium is off, we're kind of like, a little cuckoo. Matt, Tell me, from your perspective, are we stable? Are we getting more stable? And by the way, we talk about Manhattan a lot, but what about the other boroughs, Brooklyn and Queens, which happen to be a lot more robust than Manhattan at some point, sometimes, not always.
Yeah, I think that we are the one word I would use to describe the market right now is efficient. Manhattan, as Jared mentioned, I actually read the article. It was very, very well said. We are a painfully efficient market. If it's priced right, it sells. There's no real hesitation when all the factors that go into marketing a property are done properly, and the most important part of it is pricing. You still have those aspirational sellers and their inventory sitting. You still have properties that need work. Buyers are very skittish about that. But I also think that it's sort of a tale of two cities in a way, because while Manhattan as a whole is, and Brooklyn pretty much is performing relatively the same, is showing signs of an equilibrium, you have, when you go into the subsets in the neighborhoods, it's a very different story. For example, if you go to the Upper West Side, if it's renovated and it's in good shape, you can even push the pricing a little bit higher. It's gone in a matter of days. You go to Midtown East, for example, total opposite.
Yeah.
Some neighborhoods have really recovered past their COVID lows, and some even surpassed them, while others are still struggling. The financial district is a fantastic example of that, because now we have the return to office. So the office conversions are off the table because people are now returning to that neighborhood. You have a lot of commercial development down there that is attracting people, but the prices just have not caught up to where they were in the last upswing that happened post Hurricane Sandy, for example. So, if you look at the high level numbers, things look quote unquote normal, but if you drill down into individual neighborhoods or even price points within neighborhoods, it tells a very different story. And that can be opportunistic for buyers or sellers, depending on where you're choosing to focus your efforts.
Let me ask you a question, because we touched on this a couple of weeks ago. You mentioned a minute ago aspirational pricing with some sellers. It still kind of exists. What does it take to get these sellers to understand that in a questionable market, and we'll leave it at that, you can't overprice because you're not going to sell. You're going to sit, and it's only going to make the rest of the market drag.
Right.
What do you tell these people? I just recently had a conversation with someone, and they actually saw it my way, but it takes a lot of convincing.
Right. I think, aspirational pricing has only, in my experience, only worked twice. Once was 2014 to 2016.
As we talked about earlier.
And then beyond that, it really comes into the ultra luxe and trophy property section, where have to have it. Your 70 vestries, your 64 universities, those marquee addresses where, like Greenwich Lane, doesn't matter what they're asking, someone's going to pay it.
Yeah. It's always been that way for that
right.
area.
I think, but going back to another, actually probably the last episode I was on here, the education process when you're first speaking with a seller to try and sort of snuff out any opportunity for them to have aspirational thoughts about pricing is key. And part of that is showing different price points. What I like to do is basically establish a pricing floor and a pricing ceiling, and then show how quickly the floor and the ceiling have gone into contract. It's not just giving them comps in the neighborhood where the apartments look similar and this is what they sold for. It's how quickly did they sell, how many price adjustments got them to that point, and then following the last price adjustment, how long did it take to get a contract signed, minus a week or two for due diligence. That sort of gives them a very good idea of basically the different scenarios that can play out if they choose to aim high, shoot for the moon, or price it properly, or even underprice it slightly, which more times than not actually is the most successful strategy, but it's the biggest risk.
I totally believe in underpricing, but we all know when you do that, they freeze. The sellers freeze. Like, well, why do you want to, ask less than what my apartment's worth?
Well, the presentation has to be perfect for that to work.
And it's about control. Sellers can choose to have as much control or give away as much control as they want. If they underprice slightly, they'll create as much of a seller's market as they possibly can. If they choose to overprice, they don't understand, because it is sort of counterintuitive that they're giving away all control to the buyer.
Right. And after 2 weeks, you're kind of chasing the market
shot
at
your
that
foot,
point.
yeah.
Those first 2 weeks are so crucial. If you don't get your number,
First 2 weeks,
You
absolutely.
know where you're priced.
Yeah.
I always tell them, we'll know exactly what the temperature of where we are is immediately. I mean, you even know that even before you show because you get a sense of the velocity of the inquiries.
Absolutely.
You know?
Absolutely. Roberto, though, are we seeing price stabilization across all neighborhoods? None. And there are some areas that are still more volatile than others. I mean, Matt mentioned a minute ago that if something is renovated on the Upper West Side of Manhattan, and I'm assuming the Upper East Side as well, because I've seen that, it's going to move faster. What about the volatility in all neighborhoods?
I mean, generally, I think that pricing, like I don't consider it volatility. I don't think any of this is volatile. We've been so flat. It's been so from 2015, we were kind of seeing the air come out of the balloon right until 2019. And right as 2020 hit, we were all just anticipating, here it comes.
Oh, I remember
And then we
well.
get hit by COVID.
I remember well.
And then we got pulled back. And then we had probably the largest additional bump in pricing was the recovery in 2021 because things were actually going crazy. Pricing really got high and you could be aspirational, which to me, if the market is slower, it's a little risky to price low because you may not get that velocity. You might not get the demand to bid up. If you have a lot of demand, you can price almost wherever you want. But since then, we had COVID, we've had tariffs, we had every time we're just about to break out, it pulls us back, and the market pricing has been fairly flat through all of that, which tells me that our market is so solid, and we're really just kind of bouncing along the bottom. We're just bouncing along the bottom. That's our floor. We are at our floor with generational wealth being going to be transferred. Everything else that's coming, we're at the bottom, and it's going to start to accelerate.
Okay, listen. So we're going to get to tariffs in a minute, but Jared, I want to ask you, based on all of this, okay, and solid and stable and whatever. What's the current buyer and seller mindset as we're looking through this stable market, as we're calling it today? What are they thinking? I mean, agents have one perspective, and we, deal with the up and down of markets all the time. But what's the buyer and seller thinking right now? Do they really feel like things are solid and stabilized, or are they still kind of waiting to pull the trigger because they just really don't know?
It depends. And I'm going to take the roundabout route to get to the answer to your question because I think the context is really important. So first is Manhattan and Brooklyn, or all of New York City as a whole, is hundreds of submarkets, neighborhood, price, block, building. So it is easy to sit here and give you the aggregate numbers, and the headline numbers are important to be able to get the data points, but so many different segments are doing so many different things. Under 2.5 is moving strong. Upper West Side, as we've talked about. FIDE has been struggling. Brooklyn has been actually decelerating a little bit while Manhattan's accelerating, which is interesting because for so long, Brooklyn has been, really the hot train. But it is still fundamentally a normal market in Brooklyn. If you zoom out, our prices we've been talking about are just starting on the aggregate across New York City on an average price per square foot, breaking out of their 8-year price ceiling. It's been almost 10 years since New York City has seen any meaningful appreciation, as we've talked about. Nationally, most of the markets have gone bananas. And if you look at the markets that were really hot during the early days of COVID, they were secondary and tertiary cities. Austin, Texas, South Florida, Boise, Idaho, Nashville. And these markets benefited in part because there was population migration and there wasn't a commensurate increase in new housing supply. Austin is a perfect market to look at because there has been a lot of migration of tech companies there in the early days of COVID as they were decamping from Silicon Valley. And that market saw a ton of population inflow. It saw a rapid price increase of 20-25% year over year for 1 to 2.5 years. And now people are left holding the bag. Why? Because no one is moving to Austin right now because the tech companies are laying off and not hiring. So you have a freeze. You have people that were laid off are not able to sell their properties. So many of these markets that were secondary or tertiary cities are currently buyer poor and supply rich. If you look at the Northeast has lagged behind the national market. Why? Because people wanted to move to areas other than the Northeast, but now the New York City suburbs remain incredibly in demand and supply constrained because people are still locked in their home from the lockup effect with the interest rates. So what's really interesting is to see that the Northeast and the New York-centric markets are actually the ones that are doing well now, and the rest of the country is sort of suffering. Even California, that suffered during the early days of the pandemic, is starting to do well. So it's really an inverse of what has happened, and this is important because New York City traditionally does well in a counter-cyclical environment, meaning that when the other parts of the country are hurting or the economy as a whole may not be humming at all beats, New York City does well. So a mild recession, now again, no one wants a recession, no one wants economic pain. But having said that, a mild recession will actually be good for New York City. Why? One is it'll reset the interest rates a bit, sure. But two, companies have been desperate to be able to bring employees back to the office. If they're able to weaken the labor market, that'll shift the balance back to employers, and it'll help companies bring people back. That'll increase demand in New York City. A rental market cannot take any increase in demand. We'll talk about that later. Rents are already off the chart, but it would benefit a housing market from a purchase perspective, especially coupled with interest rate decreases. So where are buyers today? Buyers today are very confused. What is the most important thing that has happened, and this is why I think contract activity is back to sort of normal, is buyers are now back to buying based upon life needs. So for the last 5 to 7 years, we saw external pressure, whether that was FOMO about prices going up or down, fear of COVID, shifting consumer preferences, and then most importantly, interest rates either pull or push. Today, though, buyers are buying based upon life needs. They understand that rates are where they are. There's no real expectation of rates to rise or fall in the short term of any meaningful amount. And so they're buying based upon marriage, babies, family needs, job changes. So that puts us back in the seasonal pattern. The old-fashioned thing. So
that's right.
This helps create a broker's broker market where it's good old-fashioned elbow grease. It's helping clients navigate the market. So buyers, we need to understand as a successful agent, what's their motivation, what's going to check their boxes, what are they looking for, and help them navigate that market. So there's not a one-size-fits-all approach here. This is really about how do we help meet our clients where they are and help them navigate their needs.
Okay, we got a lot to unpack there. 3 things, though: interest rates, tariffs, and inventory. After the break, we've got to take a short one. This is Talking New York Real Estate on the More Network. Don't go anywhere.
The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
We're back. So let's tackle these things: interest rates, tariffs, inventory. Jared mentioned a whole bunch of things in his presentation, his soliloquy, thank you, a little while ago before the break. Roberto, interest rates, the lion in the room, they have been for 2 years plus. I mean, everybody carries on about interest rates. I happen to agree with what Jared said. I have been secretly wishing for a recession because I believe what he said is accurate and correct. Hopefully that kickstarts the housing market more than it has been. But, what is the thought that, and I'm so tired of talking about interest rates, okay? But what's the thought out there these days on the very high end, which you play in the middle end, the lower end? What's the thought on all this? And do they expect, they being all the buyers, that this is going to change in the short term?
I don't know that they think it's going to change in the short term. But like Matt said, it's all about price. And price is all determined by the interest rate. It's all interest rates. The last 3 years have been interest rates. If you have a small 2-bedroom and you have that third kid, you've got to say goodbye to that 3% mortgage, right? You just have to. You have to accept that you're going to be at 6.5, 7. Mm-hmm. You have to. And the ball is unraveling. Things are starting to get back to normal where people are having to buy because they have to move. Or the other option is the rental market. The rental market is at an all-time high, and we haven't even hit the high season. We haven't even started.
Or the FAIR Act may be going into effect.
That. So
June 11th.
But I think the market is acutely sensitive to the interest rates. I remember last August, there was this Japanese carry trade thing that happened in the market, and the interest rates went down. Immediately, market activity started to flow. And then those numbers were reflected in December numbers. And now, it's interesting. It's the anticipation is that if we do have a recession, that interest rates will come down. However, the Fed is in a really difficult position because let's just say, just like when all the stimulus money came, it took 2 years for that to come through and then the inflation to come through. if tariffs come in and inflation hits hard, we don't know, no one knows, but if inflation hits hard and it's January, February of next year, it's going to be, and they're in this situation where the labor market is suffering and they want to, lower interest rates, but the inflation is spiking. They're in a really tough position because they don't know which way to go. So no one really, if you look at the Fed funds futures, there are some cuts coming, but that could tighten up.
But don't you agree, though, with all the, because I agree with what you just said, the confusion that buyers and sellers both have, well, if we do this, that might happen. If we do this, that may happen. I don't know about inflation or how that, affects interest rates. Most of the people don't really understand it. Do you think, though, there's a point where buyers just say, hey, I don't know what the hell to do. I'm going to just sit back and do nothing? Because I think, as we talked about offline, maybe prices will come down. Maybe they'll, plummet, as every buyer would hope to see. But that doesn't ever happen here. I think the confusion out there, the noise, is more, debilitating than anything else. I don't know that interest rates are going to come down. If they do, how much they're going to come down. Inflation has been down to almost 2%, where the Fed claims, we need to be. But then it spikes up again, and then it comes down just a little bit. We've never really achieved 2% or under. Maybe we will. It's hard to keep pace with all of this stuff. But Matt, inventory, we talked about inventory many times on this program in the past couple of weeks. Where are we with inventory? What are buyers and sellers thinking about inventory? I remember days when if you had a buyer, you took them out, you can show them 7, 8 apartments at a time. Okay, you can't do that anymore. I was looking with a rental client the other day. I came up with 2.
Yeah. You're going to hate my answer, but it depends.
You're right.
It's and as far as how is the inventory, because everyone always asks, it's like the one question you get asked in every social situation is how's the market? It's fine. It's not amazing. Even in neighborhoods that are flush with inventory, it's fine. I think the real issue that we're having right now is that in, let's say, 2017, if you wanted to renovate a 1-bedroom apartment, you can get it done quickly. You didn't have all this nonsense with insurance that's happening right now with certain buildings. And you can get it done for a fairly decent price, to the point where the numbers made sense that you could buy the apartment, renovate it, and immediately turn it around and sell it at a premium. Right now, the numbers still kind of make sense for the most part, but people just don't want to do the work. And I just did a consult on Central Park West for a Classic 6, okay? Not a huge apartment, but not a small apartment. Obviously, very well-known building. And the quote ranged, depending on what she wanted to do, between $995,000 to $1.3 million for a 2-bedroom apartment. That's crazy.
Did you hear that?
So, and obviously Central Park West apartments trade at very high levels. But this one has not been touched in 60 years, and it's been on the market for a while. Yeah. And it was, I was looking at the numbers, and it actually made sense for her to move forward with this, because, if you got it for the 3s and you spend $1 million, you end up with something that's worth around 5.5, almost 6. That works. But a lot of people just don't want to deal with all of the hoops you have to jump through to get it done. And that's really where the immediate ROI still comes into play, because if you're buying something turnkey and expecting to ride the market, you have to be in an inventory-starved market segment in order to do that successfully. Otherwise, you're going to take a hit if you sell it within, under 7 to 10 years. Right. If things continue on the current pace and we don't have some crazy market event that causes everything to skyrocket again.
Jared, is now a good time for investors, not your typical buyer, but investors, to re-enter the market? Or are they thinking maybe I can enter the market somewhere else and get a better return over time? What is the investor thinking today?
It depends on the investor. It depends obviously on what their holding period is and what their goals are. Our cap rates in New York City are nowhere near the highest of other markets, right. But you accept a lower return for increased stability, increased liquidity, right? People were drawn to other markets, like I mentioned earlier, because they had high appreciation, high cap rates, but they have potential to see prices drop. to me, what I think is actually most beneficial for our market right now is the weakening dollar. Now, the dollar is not as weak as it was, a few years ago, but it's certainly getting weaker. And that's going to help make this cheaper for international buyers to be able to come back. So we are seeing an increase in European buyers look to purchase here as a way to be able to diversify, their assets. Say what you will about what the U.S. is doing on the world stage. New York City, I don't see it losing its luster as an international destination, as a top 5 real estate, ownership locale. So lower or weaker dollar is driving some increased foreign demand, which is helping. And they're not necessarily buying from the same cap rate perspective. They're buying because they want to have, generational wealth. They want to have diversification. They want to have store of value. And to me, real estate as an investment vehicle is so important now in all this chaos and noise. And this is also in that Forbes article, talking about how it's not pinging you every second in your pocket about what's your crypto doing or what's this stock doing. Like, it's steady, it's stable, it's there, it's a preservation of value, and it helps to create this sort of emotional well-being where you're not constantly in your head about, do I buy, do I sell, what do I do, sort of thing.
It's really interesting you mentioned generational wealth, which I have been, telling investors for years, versus cap rate. And it's interesting how things seem to be stabilizing in that regard with an investor thinking, hey, because for the longest time, it was almost impossible to get an investor to accept a cap rate that was 2 times and 3 times higher than they wanted to pay. But we always said, but think of the value of what you're buying today, and then think about the value somewhere in the future when you go to sell. Generation worth and wealth is important. Why has that stabilized, though? What was the impetus for them to think, all right, because look, foreign buyers stayed away for the longest time for a whole bunch of, politic reasons and whatever else, stayed away for a long time. They started inching back until things got really high. They buy condos. You look at real estate taxes through the roof. You look at common charges, what used to be fairly decent, through the roof. Okay, purchase prices, pretty stable. But you add all of that together, if they want to turn around and rent that unit, an investor, even though the rental market is zooming and booming, they're still
the numbers don't work.
Convinced that the numbers are working.
The numbers don't work if your model is the income stream.
Yeah.
It does not work.
It does not. But generation wealth,
that's different.
Buying for the future,
if you want
adding
your piece
to your portfolio.
of the apple, and you want, you're an international buyer, and you want to have something in New York and have that international part of your portfolio, et cetera. I mean, for sure. I mean, I think New York, we're all here because of what New York is. But if you're trying to do it from an income stream, and you're an investor who has, you have properties in Omaha and you have properties in Ohio, et cetera, and you're looking for that, that's not.
Yeah,
that's
it makes no sense. No.
Right. Matt, what's next for the rental market? I mean, we've got so much more to talk about, but, I'm thinking rentals at the moment. Where are we going with this hot rental market?
I mean, it's exhausting.
It's exhausting.
It really is. And
exhausting.
I think that it's really going to come down to a shift in politics that's going to ultimately change the trajectory of the market. Otherwise, we do pretty well as real estate brokers in New York City. I still can't totally understand who is affording these apartments at these prices. I just had a client that was in a bidding war for a 2-bedroom in Hudson Square.
Yeah.
She ended up going, $1,500 over the asking price. We were throwing things at the owners. You have to sweet talk them. It all comes down to your relationship. I mean, I've had multiple deals where they went with us or they just heard us before everyone else because of the relationship. But between the nonsense happening with all these rent stabilized apartments and the FAIR Act coming up, which no one knows what's going to happen, but people already seem to think it's a law, even though it's not a law.
Yeah.
There's so much explaining that has to happen with this market that, when you have someone who's coming to New York for the first time, and I've had at least 3 or 4 renters get referred to me that are moving to New York between now and October. And when I explain the landscape to them, like, their heads explode. and I was like, look, I don't blame you. We have a severe housing shortage for rental apartments because there are tens of thousands of apartments that are locked up and vacant that landlords just refuse to improve so they can release them to the market. But until that gets figured out, we are on, I think, a very dangerous path where we're moving towards such severe unaffordability and a lack of inventory that it's at some point it's not going to be sustainable, but the supply and demand effect, like Econ 101, is just going to keep it on this path.
Listen, I had the exact opposite of what you just described. I had a referral come in last week, somebody that I sold something to last year. They're moving to New York, okay? Indefinite period of time, 2-3 years, and they want a 2-bedroom apartment, okay? Because they're going to keep their place in Chicago and also in Dallas. And I said, all right, so, blah, blah, blah. We talked about the neighborhoods. They went downtown. I said, so what's your budget? And he said, well, $18,000, $22,000, $23,000 a month is fine. And I'm thinking, you want to spend $18,000, $22,000, $23,000 for a 2-bedroom apartment. Would you be interested in buying something?
Why wouldn't you buy something like that?
100%.
That's a $2.5 million apartment.
Right. You know what the answer was? Nah, we don't want to buy. We already own two properties. Clearly,
but that's what I'm saying.
Cash is not a problem with them.
I don't know where all these people come. There's just there's
Well, I
one.
don't know where they're coming from
It's
either,
obviously very commonplace for us in New York City to experience clients like that.
Right.
But the sheer numbers of them,
Yes,
and they're all coming back from Florida. They're coming back from California.
Absolutely.
Everybody
Absolutely.
that left during COVID, a large chunk of them are finally fed up and miss New York and are all coming back at the same time,
and
which is
cash
just
flow doesn't seem to
exacerbating
be
the
a
problem further.
That's actually the most important fact of what's happening in our market right now is that you have that return of population inflow, right? So you have money that is coming back, especially if they've made money, in their markets elsewhere. And to me, it's absolutely crazy. Rents are up 9.5%, year over year. Every month they're pushing new highs. We're not even into our peak season. And if the FAIR Act takes effect, you can easily expect rents to go up another 5, 8, 10, 12, who knows what percentage. And our city council continues to believe that broker fees is the issue with affordability.
But at what point does it just literally become unaffordable because there is so much money and people are coming back. And this is also a marketplace where it's not just primary users. People have houses everywhere. Right. And then they want a place in New York. On top of the fact, when COVID happened, people left the city and they bought other places or went to the second house, but they never sold their primary residences. So they're inventory is really tight. And this conversation you have when people first come to the city is always the funniest thing in the world.
Hilarious.
Back in the old days, I used to have I literally called it the sad reality sheet. And I would literally email it to him and say, you need to read this.
To bring that back.
And it literally outlined the whole
the
thing.
7 inconvenient truths.
Then let's have another conversation.
Well, exactly. And it's, still after all these years in this business, I sit back and think, okay, if that's what you want, I'm certainly here to help you do it and we'll be successful. But, maybe you want to buy something, at that kind of price point. Cash flow to some people, doesn't matter. But Roberto, let me ask you, because you've recently closed a whopping big deal. He's one of our top, well, both of them, top producers here, and you put some numbers on the board. Were you number one for March or April? I can't remember anymore.
February.
It's
already a long time ago.
It's already a long time ago.
Water under the bridge.
Do it again. Number one in the company. All right. So what's the difference these days, luxury versus just the normal market? How is it performing in this whole stabilization of our market? Obviously, all cash, $10 million and up seems to not have a problem. But then anything under that is kind of like, weighing everything and not necessarily pulling the trigger on everything or anything.
There's so much more competition the lower you go down the scale, right? Because that's where the masses are. When you get up to the top, pricing is all, I have a client who's like, what can we get for that now? And it's a really expensive place. And I was just like, it's a little bit like you throw a price on it that you think is fair and you just see where it goes, because it really depends who's in the marketplace at that point in time. I have a buyer with a very large budget and, I say, do you want to, how much are you willing to spend? And we're looking at things 20, 25 and say, and I said, there's something here for 40. He's like, I don't really want to spend 40, but maybe we should look at it. I mean, that's a wide range. And they just, it becomes a little bit like monopoly money that just doesn't matter.
Right.
They have it.
As
it's kind of like an ice cream sundae. How much whipped cream do you need? You got to take all that off. But down here is where the guts of where everybody is. So, I forgot the question.
No, the balance between, that market and the regular market, under, say, $5 million.
It's all, I still think it's interest rate sensitive because it's all about affordability.
Right. And there's a difference between people who finance because they need to finance and finance out of convenience. Right. So, the 10 plus when you're dealing with like literal monopoly money, that is, you're financing because you don't feel like locking up assets, But if you're, and then obviously under $2 million, those are necessity-based financing, unless they're getting, parental assistance, transfer of generational wealth. That 2 to 5 range, even like 2 to 6, that's where you have sort of this slushy mix of people who can very comfortably pay in cash and people who are stretching to finance that forever home that they think, this is it, I'm gonna get carried out of here in a box and I won't ever need to buy an apartment ever again. So I might as well just go for it. And now that people are getting, I've been seeing ARMs pre-approved in the low 5s. A lot of my clients are high 5s, low 6s. People are being like, I can do this. Yeah. So, but you have 2 different segments of buyer, and that middle ground, the 2 to 5, 2.5 to 5, 2.5 to 6 range in New York City, which is luxury anywhere else.
Luxury.
That's where you're seeing it's a weird hodgepodge of needs-based versus this looks fun. This looks nice. I want a piece of New York. The 5 Ds are very much still in play. Debt, divorce, diamonds, diapers. That's our business. Debt, divorce, diamonds, and diapers.
That's our
the
business.
5 Ds of real estate. But it's not panic buying anymore, panic selling. You're going back to the basics on that front. But the methodology that gets you across the finish line has completely changed. And I think that's what you were referring to in your intro, where some brokers have chosen to just dive into the tornado head first, while others are kind of like staying there waiting for maybe it'll pass. This is unfortunately or fortunately the new normal. And you're either going to sink or swim. If you just have to figure out what you can take from the past and then how you alter it to really benefit your business in the future.
You mentioned, Jared, in your brilliant soliloquy earlier in our first segment, lifestyle. People are starting to think about lifestyle, think about, wanting to be here for personal reasons versus, interest rates and whatever else is out there, all the noise. Tell us a little bit about that. Why are people putting more of their personal whatever into a purchase or into a high-level rental and saying, okay, I don't really care what the market is doing right now. I need to be here. I want to be here. This suits my lifestyle. This is what is happening. I'm going to go for it. Matt said it before. Hey, maybe I'm going to get carried out in a box. Yeah. So I'm going to buy that home that's going to make me happy.
So real estate, serves a fundamental need of shelter, right? But for most of the people in our market, real estate is something other than a fundamental need. It's an experience. Right? Every home creates the ability to live a certain lifestyle, and people are back in New York because we're an experience city, right? We're back in that real estate experience, we're back in that experience economy. So people are coming here because it will allow them to do something. Maybe it's because they want to come back and enjoy the dining, the entertainment, the theater. Maybe they're just deathly tired of having to board up their windows for hurricanes or that, Florida heat. Or, they move.
I don't want that.
Or they moved their family, out of the city during COVID, and now they're back to 4 days a week, and, they're really miserable sitting on the train all the time. So they're going to buy a larger one or a 2-bedroom near where they work. We're seeing a resurgence in Midtown West demand to some extent for these 2 bedrooms that are efficiently sized and efficiently priced, because there's been a huge surge of office, occupancy around Hell's Kitchen, Hudson Yards, Midtown East, that whole sort of area. So we're seeing all sorts of different needs materialized here, which is creating a lot of different demand. But it all boils down to people want to be able to experience something, and the city is such a diverse set of opportunities that create something for everyone.
Okay, we're going to take a short break. Everyone is staying here. We're going to come back and talk about the FAIR Act. We're going to talk about tariffs, and we're going to talk about the National Association of Realtors and that settlement as we discuss what is next for New York City real estate, or as I call it, my town. Don't go anywhere. We're coming right back.
This podcast is supported by the More Network, powered by Brown Harris Stevens. Real estate touches every aspect of our lives, from design and architecture to investing and the economy. Now there's a way to get all your real estate information in one place. The More Network. With more than 20 podcast and webcast series, the Mastery of Real Estate Network is powered by Brown Harris Stevens, one of the country's most distinguished brokerages. Discover advice from notable entrepreneurs, compelling topics, and access to top global real estate experts. Subscribe to their YouTube and Apple podcast channels by visiting GetMoreNetwork.com.
All right, we are back. I'm going to talk about, as I said, the FAIR Act, tariffs, NAR. But before we do that, because something came to my mind last week, I wanted to show a property in Brooklyn, and I emailed the agent in my nice little old way, and I got this within 2 seconds. I got this very, very nasty email back saying no, in capital letters, and I thought, So I read on. I don't deal with agents. I don't show other agents' clients. They can come directly to me. I don't share my commission. She went on and on and on. And I'm reading this, and I thought, oh, wouldn't the Department of State and Real Estate Board of New York love this? So I said to her, are you a member of REBNY? No. Okay. I haven't reported her yet, but trust me, that's only because I haven't had time. But believe me, I'm going to do that. I cannot even believe I have never had not even a conflict. She just sent me this email, and then I asked for something else, and she sent me the same snotty email back, and I'm like, So, Jared Anton, when we are out there, in order to make successful transactions work for our clients, work for us, we run up against that, or maybe not as serious as that. What do we do? How do we do it better? And what's the result?
Yeah, so we've all experienced those agents that, we're happy to pick up their phone calls and we look forward to doing another deal with. And we all have that list of agents that we dread the day that they call us. New York City is super unique in the fact that we don't have lockboxes, right? So unlike the rest of the country where you can just go and show the house, at your convenience with never seeing another human being.
That's a terrible thing.
We need the listing agent to let us in. So we need to coordinate so many schedules between the sellers, the listing agents, the buyer's agents.
What do the listing agents do in the burbs? Play pickleball all day while somebody else is showing their apartments?
I never really
really
understood that.
I don't like it. I'm sorry, I
That,
interrupted.
that's how you can be a part-time agent elsewhere, or that's how they manage 50 listings at once.
Yeah, okay.
But when the prices are a lot less, you got to
Mazel
handle
tov.
a lot more volume. So it's so amazing to me when I run into agents that experience or look at the other agent as their adversary. Fundamentally, like a buyer and a seller's agents are representing different parties, sure, but everyone wants the same thing. You want to be able to create a meeting of the mind. So from my perspective, you have to be nice and collaborative with that other agent. You have to treat them, with mutual respect because you both want the same thing. And if you want that other agent to go to bat for you, but more importantly, your client to the seller, especially if you're coming in a multiple bid situation or last minute trying to swap a deal and contract, you got to show up nice, trustworthy, with respect. And most importantly, you have to be able to instill that confidence in the other broker and in the seller that you're going to deliver and you're going to get the deal done, because they're taking a risk. And if you try to strong arm, if you show up like an ass, it's not going to help you, because is that other broker going to want to work with you? Is that other broker going to be able to demonstrate to the seller that this attitude is trustworthy and one that they can count on delivering a deal? I question that, right? So what I think is really important is, as this market is in this sort of sense of normalcy, and it's this good old-fashioned broker market where neither the buyer or the seller necessarily has more power than the other, this is the time where that collaboration, that good relationship is key. So I want to use this moment to call on us in the industry to show up with respect, with compassion, and treat the other side as you want to be treated, because so many of us are not just on the buy or on the sell. We're on both sides, and what goes around comes around.
Roberto, we talked about the FAIR Act. It's going into effect on June 11th. Okay, so it's really going to affect. What I say on the show all the time is the only thing we can count on in real estate in New York City is change, okay? And we started 2025 off with so many different things about to happen, change. You can look at it in a good way. You can look at it in a bad way. The FAIR Act, I think, is kind of tragic for rental agents out there, or the entire rental business out there. Starting June 11th, the only person who gets paid a commission is the listing agent, and that is paid by the landlord or the owner of a condo. If I take a renter out, I don't get paid anymore, and worse yet, not allowed to be paid.
If the tenant hires you as their tenant's representation,
can they do that?
Yep, you can get paid.
Okay.
So what we're going to see is really, in my opinion, the creation of, just so we've created these buyer rep agreement, we're going to have a tenant rep agreement where the tenant's explicitly hiring a broker.
Well, that makes me feel better. Okay, perfect. Do you see that affecting our rental market in a significant way, or not? I mean, the rental market right now is hot, so we're all kind of focused on it and paying attention to it. What are your thoughts on that?
It's a little bit of a long answer. It goes back to, I think our barrier to entry into our market, into our industry, is very low. And a lot of the people who are doing most of the rentals are typically starting and they are in a lower price bracket of income and things like that. And they are not as versed to deal with the paperwork and the negotiation with tenants, prospective tenants, to deal with it a lot. And I think it's going to affect their income. I think it's going to affect the industry tremendously. But, and I don't do a lot of rentals,
Yeah,
but
me either.
it kind of actually there's so much paperwork in a rental. It's absolutely mind-boggling. It almost frightens me every time I get a guy that wants to find
it's
something.
overwhelming.
So-and-so's, listen, my daughter just graduated. Can you help her?
I know.
And, I take a deep breath and I say, okay, yeah, I can do that.
Sure.
And then I go to my manager and say, where's the long list of all the stuff they need to fill out?
Right.
And then I send them the sad reality sheet.
Right.
And,
Right. No, I
but
feel the same way.
I find it it's complicated. And I don't want to, I'm almost not preparing myself for it. I'm just going to see what happens and then just ride the wave and do what I need to do.
Now, do you think there's going to be an appeal of any sort that's actually going to make a difference? Or
Well,
do you think
Webney
this
is
do you think
supposedly
this is
fighting
really
an
how
organized
that's gonna
appeal?
happen? Yeah.
I don't
No,
know.
nothing's organized. Nothing's ever organized.
It is still being adjudicated through the courts. Supposedly the courts will rule later this month. So it is still to be determined whether or not it is or is not going into effect June 11th. If the city council wins and Redney loses, arguably it would go into effect. Either party may still appeal. That wouldn't necessarily stop it from going into effect, though, in that case. So I think we have to prepare as if it is going into effect and hope that it doesn't. But there are a lot of nuanced changes, and not like the buyer rep and the commission piece where it was a lot of noise and some procedural changes. This one is going to have a real, in my opinion, market impact, and not necessarily for the best.
I mean, I don't do a lot of rentals,
Yeah.
kind of like
I don't think any of
Roberto
us
said.
do, but
But
yeah.
when I do them, I agree. They are incredibly time consuming. Obviously, you get paid a lot faster, but the amount of work that has to go into it and the amount of sort of legwork that has to happen before you can actually start looking at things, just because the market is so tight and expensive, is astounding. I mean, I almost sometimes will tell, a client's, recent graduate daughter or son that's moving to New York that a self-guided search is likely going to benefit you rather than having me in the equation. I'm happy to assist and guide from the sidelines.
Correct.
As, a favor.
Because they're going to do that anyway.
Right. But it's not worth me trying to, fight 40 other people at an open house to get them into 6 listings only to get rejected as the 23rd offer because I'm in the picture and the other agent has 13 directs that doubles their commission.
Right.
Obviously, that's going to change. But I also think that, we, as I mentioned earlier, we are on sort of a boom cycle where there is no real event that is going to cause the bust. And this FAIR Act is only going to push prices higher. And there's literally no attention whatsoever to what rent stabilization laws are, how those are impacting the rental market. And that's where that's the core of the affordability crisis here. And nobody's addressing it. It's crazy. They're very quick to, take money out of the brokerage community's pockets, and they're very quick, which is ultimately going to impact
Buying
the consumer.
pants without pockets.
Yeah, seriously. But they're not addressing the actual situation, and I find it mind-blowing that not a single politician has even tried to address this, because any basic economist or financial analyst can take one look at these numbers and figure out exactly where the problem lies and how to fix it.
And what's the problem?
Affordability, but it's coming down to rent stabilization laws
And
the
supply,
fact,
right?
and the lack of supply as a result. I mean, it's Econ 101, and everyone's like so quick to say, oh, that'll, less broker fees, amazing. You'll owe less upfront, but that's not going to help the market at all.
Don't get me started on politics. So, Jared, for sellers, is now the right time to list, or should seller kind of sit back and wait for a little more momentum to happen before they feel more comfortable to put their apartment on the market, thinking that with a little more momentum, they can get maybe a better price?
It depends on what their goals are. Again, there's no perfect time in this market. So if a seller needs to sell, now's a great time to sell. We're almost at peak inventory for the season. What that means is buyers are going to start circling back to inventory that they previously passed over, and you're going to start having less, not more supply in the next 3 to 4 weeks. So if a seller wants to come to market and hit this moment in time, you got about a week or two to get your property on the market before you miss the window. If you have something under $2 million, the market doesn't decamp the city in the summer, so you still will have some velocity there. Otherwise, you sort of regroup and get ready for the fall. I don't believe that next year is necessarily going to be materially better than this year. There's a whole lot that can happen or not can happen between now and then. So, that in previous years, I would have said wait until this moment in time. So this moment in time that we're experiencing today is probably as good as it's going to be right now. And I don't know that it's going to be materially better in a year from now. Will prices be higher? I hope so. But what does that look like from a competition? What does that look like from, supply and demand? Where are we from a macroeconomic or recession and non-recession piece? So the only certainty that we have is what we know today.
Roberto, as I say all the time on this show, buyers are in their homes, under the bed, door locked, waiting for something, okay? What is going to be the impetus to get those buyers out from under their bed, unlock the door, and run down that street with their hair on fire? What is it going to take for us as an industry?
Our market is so efficient. I think there's always demand in Manhattan. It's just there. If you take a scalpel and you slightly cut that skin, it's just all going to come out. It's all right there. Pricing needs to come down, and interest, and only in the sense of if interest rates come down, I think it's all interest rates. When the interest rates come down, it makes it more affordable. More people will flood into the marketplace. I was kind of thinking on my way here, I was like, it's interesting because buyers don't have to buy, but there's often sellers have to sell. So the sellers are really, the sellers need the buyers more than anything else. Mm-hmm. The buyers are the ones with the money. And they need to get to a place where they can transact. But the buyers will come off the shelf when the interest rates come down. And a lot of it's mental. If you have a 3% mortgage,
100%.
To accept even, but I'm a huge in both for buyers and sellers. You need to transact in the market you've been given. Unless it's the financial crisis or, COVID just started and there's something absolutely extreme happening. You should transact in the marketplace that you're in so that you can move on with your life and go live your life, make your plans, do your thing. It's not going to make a difference, 2,000 or 3,000 or 50,000 this way or that. It's just you're going to live your life.
Right. But as you've all indicated, though, post-COVID, boom in 2021. I mean, the 2021 into 22 market was unbelievable, 22 for the most part. But what I have seen and all of you have seen is post-COVID, common charges and maintenance has skyrocketed. Real estate taxes have skyrocketed. Now you want to throw in double interest rate. Buyers, sit back and say, whoa, I don't make enough money or bring in enough money every month to pay my monthly bills. So I can't buy. I don't know how we change that. I mean, we've talked about that ad nauseum on this program, but I think that we do see some stuff kind of stabilizing. I think, like you said, Roberto, once people kind of eventually get used to what we are and what we're doing, that kind of gets a few of them to get off the fence. But I want to ask, one last question. What could tip the market back into growth or decline from here, okay? Now, the word I want to use at the moment is tariffs, okay? According to my buddy, our chief economist down the hall, he tells me tariffs have nothing to do with the housing market. It's all going to work out, blah, 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 blah. And I say, no, I believe the housing market is effectively going to stall because of tariffs. Again, because of buyer, unknown facts. They hear the word tariff, they hear prices going up, they hear whatever. Doesn't have to affect prices in housing, but the housing market always is. What are your thoughts on tariffs? And are they going to hurt our market in the next, 6 months or so?
So the national market, I think it's going to have a much larger effect. I described some of that earlier. I think it's going to have less of an effect in New York, and there's a sweet spot where it might actually have a benefit to New York. A very, very small sweet spot. On the aggregate, though, anything that gives buyers pause. I mean, April, we saw it didn't show up in the contract volume because thankfully the undulation in the equities market was fairly short-lived and we flip-flopped very, very quickly. Actually, we flip-flop. I think I got that right.
But probably, only to happen again.
But it didn't show up in the data, but it certainly did in those 7 to 10 days create a lot of pause. So anything that creates uncertainty gives people a reason to pause, and real estate is a big purchase decision. So it's certainly going to not necessarily help us. To Matt's point too about the renovation, everything coming in, there was a great New York Times article a week or two that basically had this graphic showing everything in your house, what percentage of it is imported from China, like 99% of alarm clocks are imported from China, bunch of, appliances.
People still have alarm clocks?
I don't know.
You took the words out of my mouth. I was just saying alarm clock.
That one stood out. So it's going to make renovation that much more expensive, right? Labor and all that stuff. So it's going to create this sort of unequal playing field. The short answer is no one knows, right? We're sort of going day by day and seeing what's going to happen. But the benefit is creating certainty. Any sort of uncertainty creates a little bit of chaos.
In the short term, is there anything that could tick up the market and make the market, zoom?
Interest rates, right? I mean, if the Fed drops, but the Fed's in an even harder place than normal because, as Rob, described, it's a dual mandate between managing, growth and managing inflation. But now you have our president chirping in the background that they have to drop rates. So they now have this other force that they need to remain apolitical. They can't actually bend to that pressure. So to me, it's almost more reason that they're going to sit, longer at holding rates, where they are, and they may actually hold them too long where they are, and we're going to go the other way. So the more he chirps, the harder it's going to be for them to actually respond, in my opinion.
I think, but part of what's been so difficult to pinpoint what it will take to eventually start an upswing or a decline is the fact that for the last 5 years, we have basically been dealt a hand that involves what I would call whiplash politics and a hypersensitive financial markets as a result. Those two things coupled together will stifle any growth severely in one direction or another because overall the long-term average just ends up being flat because you have, oh my God, tariffs, everything goes down. Oh my God, interest rates are dropping, everything goes up. You have someone tweets one thing, and then all of a sudden the financial markets go into a frenzy. I think everyone forgets that 4 weeks ago, everyone lost 20% of their net worth in 1 week.
Oh, people haven't forgotten.
We all came back, right?
Then they made 8% in one day, then lost 6%.
So like if you look, I just read that April.
I heard on the news yesterday, everybody recouped everything they lost over the last month.
But that's what I'm talking about. That
really.
Right, but that event did nothing. It didn't cause a downward spiral. It didn't cause an extreme upswing.
But don't you think it's because people just freeze in place like, oh God, what's going to happen next?
No, because this is the new normal. We're in a very interconnected global stage where one sort of action has an equal and opposite reaction, but it's not just within the US, it's everywhere. Yeah. And because of advances in technology, because of AI, because of algorithmic trading, you have all of these forces that are fighting each other. And it just ends up being a murky mess of flatline. At the end of the day, everything is still exactly as it was, and everyone went into a frenzy for nothing, right? Yeah. So what is it going to take?
That's the human way.
Right.
Get into a frenzy and then all of a sudden calm down.
No, but if you think about...
Have a vodka, you feel better.
think about 25 years ago, the post-2001, okay? Post-9/11. That was a very different time with a very different landscape where our economy was in a much different place comparatively to... compared to how it is now. Mm-hmm. We weren't doing things to instigate leaders on the other side of the planet. We had a stock market that was rallying behind growth and rebuilding and America First. That was the last America First movement, was post-2011 when the whole country banded together to fight terrorism, right? Mm-hmm. But as a result, you had shifts in the market. Lower Manhattan was in the toilet. Everyone was moving uptown. Offices were getting emptied. There was a lot of shifting that caused sort of a rebirth from Manhattan's rebirth. And then post-COVID, same thing, but we were in a totally different time with a totally different set of tools and levers to pull. And I don't think anyone's really figured out how to navigate this up or down long-term in the future because I don't think anyone really knows what they're doing sometimes. I mean, the people that are in control just don't really seem to understand how all the pieces fit together yet. Because this is the last 5 years have brought around a very new world that we're living in. And people are still trying to, quote unquote, figure it out. Unfortunately, it directly impacts hundreds of millions of lives on a daily basis. And until we figure it out, things are going to stay stagnant. New York will always be in demand, but I don't see pricing moving up or down significantly in any way, shape, or form. It's gone up a little bit.
Stabilization.
But over 5 to 6, 7 years.
Yeah.
The trajectory, I see the trajectory literally not spiking.
No.
But we're starting to go up the hill.
It's a slow,
it's going to be a
slow increase.
Exactly.
Yeah.
But it's going because there's so much demand, generational wealth, everything,
Absolutely.
and with finite supply.
What did I say in December? It's just going to be a slow burn. That's really it.
I totally agree. Okay, with all that said, I'm coming back with my thoughts for the week right after these messages. Don't go anywhere.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back with my thoughts for this week. So New York City real estate has a unique resilience that sets it apart from other asset classes, especially in times of economic uncertainty. Residential property in New York City offers a rare combination of emotional and financial stability. Unlike stocks or crypto or even commercial real estate, owning a home in New York City is not just a financial decision, it's a lifestyle choice. Thank you, Jared. Rooted in identity, permanence, and pride of place. This emotional connection creates a built-in demand, particularly among global buyers and long-term residents who view property here as a legacy investment. At the same time, the limited supply, strong rental market, and continued cultural and economic relevance ensures that values hold firm even when other markets twitch or tumble. It's this dual appeal as both a secure financial asset and a deeply personal investment that allows New York City real estate to weather volatility better than most other places. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, Blue Sky, Substack, oy vey, or TikTok at Vince Rocco. And Norman Vincent Peale says, shoot for the moon, everyone, because even if you miss, you'll land among the stars. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for joining us today, spending a part of your day with us. I am truly grateful, and I'll see you next time. Goodbye, everybody.